when all of this rehypothecation and phantom gold, when this story falls apart, then that alone has to increase the gold price big time. Hi, everyone. I'm here with Jeff Clark as the moderator and Chris Martinson again, my friend Chris, ally, and Jeff, senior precious metals analyst at goldsilver.com, doing a fantastic job with these articles lately. So, Jeff, take it away.
Hey, it's great to be back with you guys again this week. So, Chris, how are you?
I'm doing really well. It's good to be back with both of you. It's fall, so oh my gosh, the mini farm is keeping me busy too.
Yeah, I bet. That's great. Well, let's jump right into some articles I want to go over with you guys. The first is the big news last week was the Fed actually changing their mandate about inflation. And this article, we'll put it up on the site. You can read what the change actually is and why it may or may not work. But my question to you guys is, do you think inflation is going to run higher now because of this change in the Fed's mandate? Do you expect higher inflation, or maybe do we get some form of stagflation? Because when you think about it, we have all this currency printing, but at the same time, we have major deflationary forces with unemployment, loss of businesses, etc., still going through the economy. So, Mike, what do you think? Inflation, deflation, stagflation? What do you see coming here?
I still see episode 7 of Hidden Secrets of Money. I see deflation before big inflation or hyperinflation. It's going to be sort of an indeflation, though. There will be things that are going up while, especially asset prices, will be going down. The reason the Fed did this is because they are losing control and they are panicked. They want to be able to, if they see the slightest threat, to way overreact to one side. But you know, they're sort of like a drunk driving, a crazy drunk person driving a bus. The Fed has all these models. The models are not only wrong, but they're broken. They're using a thermometer to guess how fast we're going, you know, for thermometer instead of a speedometer. They're driving with the rear view mirror, looking at what has happened in the past and how they should react to the future. So, you know, they think it's summer, but it's actually winter out. We're driving down an icy road. They're overcorrecting and undercorrecting, and we're in this, you know, spin. And the only way to save yourself, to jump from the bus, you know, this economic bus, is gold, silver, possibly cryptos, farmland, you know, being self-sufficient if you can. But what I see is that they've gone from, you know, before the crisis of 2008, they used to have like a dial and a lever, and they would try to control the economy by just dialing up these things and slowing this down and stuff. And now they've got switches and buttons. It's just turn this on, turn this off. Take a look at the charts of like repurchase agreements. And look at what we did before 2008 and what we do now. We just switch it on, switch it off. Same thing with some of the treasury purchases that we do. They switch them on, switch them off. There's times when this asset class is at zero on their balance sheet, and other times when it's a huge factor. And so they're panicked, they're scared, they know that they are losing control. And I think that what they're going to do is, well, what they have been doing is overreacting. And this rearview mirror that they're driving with can't predict these big outliers like we've just had. The last time something like this happened in the economy was 1918. And so they aren't prepared for that. That we, you know, if we had some savings, we might be able to get through this, but we don't. Everybody's in debt, including the government, that we've just spent ourselves into this hole that we can never climb out of. And then this outlier event, something that is, you know, way outside the normal bell curve of probabilities.
Okay, great. So what do you think, Chris? Inflation, deflation, indeflation, stagflation?
Yes, I think yes. In deflation, I like that, and the reason is, and I don't want to mix metaphors too much. I like the drunk bus driver. I think that's good. But I actually think the Fed's motto ought to be the beatings will continue until morale improves. I think everybody in this story, except for the ultra wealthy, are going to feel like the redheaded stepchild in an abusive relationship with bad parents after this is all done, because we already have inflation. I spent an entire chapter of the crash course going through how the government calculates inflation. And they calculate it in a way where they go, look, we don't have inflation, we need more, right? But if you lived in a city, let's say you were over the age of 70, you're on a fixed income and you lived in San Francisco, the government told you experienced 1.2% inflation last year. When if you added up rent, drug costs, prescription drug medications, food, all of that stuff, and you actually added that up, including property taxes and sales taxes and all that other stuff, you would have found that according to the Chapwood Index, that your inflation was closer to 10% a year, right? So we already have really high inflation, for one, in basic living things. So what the government actually measures is not the cost of inflation. They measure what I call it's a cost of living. So they figure that because you're over 70, living in San Francisco, you got high prescription drug costs, what do? Well, you skimp and you buy fewer drugs. So the government goes, well, then your inflation went down because you were no longer taking life-saving medication, right? It's crazy what they do to convince themselves that inflation is lower than it actually is your experience. Quick example. According to the Bureau of Labor Statistics, a car in 1997 compared to today actually costs less money. It's deflated about 1.2% every single year, costs less money. You might have noticed that the average car cost in 1997 was $17,000, and today it's $36,000. Your experience of that is it's more than doubled in price, but the government is busy telling you it's actually gone down slightly. And they have the reasons, and I can't totally disagree with all of them. Cars are built better. It's nice having airbags. It's nice having a camera to back up. But they do all of that, and they confuse what it actually costs with the value you get out of it. And so it's all a mess right now. Here's my definition of inflation. Does the stuff I'm buying cost more than it did yesterday? If it did, it's inflating, right? So we see inflation already in stocks, in bonds, in precious metals, in real estate, everything except the milk that the government measures, and says that's our entire cost of living now. It's crazy. It's crazy, you guys. It's just, I think we're already experiencing inflation. I want to give listeners permission to feel as if it's okay for them to think that maybe their cost of living has gone up a lot, and it's going to go up a lot more. And that's why I took the Fed statement, Jeff, that you asked about, is I reinterpret it as the beatings will continue until morale improves.
Right. That's a very good analogy. I think that's more true than not, for sure. So another big storyline last week was the idea of institutional investors moving into the gold market. I've written a couple articles on it. The most recent, though, was the Ohio Police and Fire Pension Fund announced that it's going to put 5% of its assets under management into gold. And there have been other institutional investors, as we've documented, that bought gold and even silver in Q2. But this is the first pension fund in 2020 to make that public announcement. So this seems to be a major shift that's underway. Mike, what do you think? Does this shift continue? Does the funds from institutional investors continue to come into the gold market? And what happens if they do?
Well, to continue, it would actually have to start first. And it hasn't really started yet. We've just heard the first of these announcements. And, the Fed, if we went back to full gold backing of, the only portion of the currency supply that's on the Fed's liability, that's a Fed liability on their balance sheet, is the paper dollars that exist. And right now, there's $2 trillion of Federal Reserve notes. The other liability is the excess reserves. There are no more required reserves. So it's bank reserves are the other liability, but that never enters the real economy. That's just something that banks use for leverage to make loans. So the Fed notes reached $2 trillion. And they have about 250 million ounces of gold. And when you divide these into each other, you get an 8,000. So they could stop all of this by going back to a fully backed gold standard at $8,000 an ounce. But they're not going to do that. what's going to happen is you're going to see gold blow way past that when all of these institutions come charging in, because there just is not enough gold anywhere near these prices. Not, these prices are a tiny fraction of what the gold price would have to be able to support when institutions start getting worried and run for a safe haven. And the other traditional safe haven, bonds, is going to be distrusted at some point or another. So they're going to run from bonds, they're going to run from all other asset classes and run into precious metals. And when that happens, get ready for some fireworks.
Yes, very much so. Chris, I actually put a graph in that chart. Maybe we can throw it up in this video, that at most 2% of pension funds own any gold and silver, at the very most. Do you see this trend continuing? And if so, what happens?
It's just exactly what happens, is what Mike said. The price explosion has to happen because there isn't enough gold out there right now. This is I would call this the Buffett effect, right? A lot of people follow Warren Buffett. He's been a very successful investor for a long time. He decided to move very publicly into gold, bought a gold mining company, a bunch of shares of Barrick, right? So that's good. And I think other people are following that. And I'm pleased for that, because I do think that is a way for individuals and pensions to protect and extend their fiduciary responsibilities. So you got to protect yourself in this environment. The Fed's being just insane about all of this. But I have some advice. So if anybody from the pension world is actually listening to this, make sure you actually own gold, not a claim on gold, right? And if you have the firepower to be putting billions in or something like that, make sure that you are personally paying for the audit of that stuff, that your bar numbers belong to your fund and your clients. Because I got to tell you, I don't think it exists, to echo something Mike just said. You mentioned, Mike, that the Federal Reserve claims they have $250 million, give or take. I think it's 261 million ounces of gold is on the books. You know what else is interesting? I did pretty good in accounting in business school. The Exchange Stabilization Fund under the Treasury lists all those same ounces of gold as an asset on their books. The Federal Reserve lists them as an asset. I'm not that bad at accounting. I don't know how two entities both can claim an asset, right? And they both do. I've puzzled over this for a long time. So someday there'll be a cat fight over who actually owns those. And surprise, probably not all those ounces actually exist for other complicated reasons. But I think right now the danger for big money trying to move into gold is that they move into a murky world where nobody really knows who owns what. And I think this is time to get simple about all this. He who owns it is, possession is 9/10 of the law in this story. Make sure you possess it. I think Texas has a depository. They were moving some of their, they had, big talks about moving some of their, I think, a teacher's retirement fund into some gold, into their own depository. Thumbs up for that. I highly would recommend that as an action if you're a pension fund. But the same thing I'd recommend for an individual, private individual. Own it. At least your core fund. Own it. Don't own what you think you own. Own what you know you own.
That's great advice. And of course, that's what we think everyone should do, is make sure you own physical gold. The greater the crisis you expect, the more critical it could be to actually not just have price exposure through a paper product, but actual physical metal. So let's jump to the next topic and talk about the gold price itself. Oh, Mike, you had
Let me make one last comment on the topic we were just on, and that is that when all of this rehypothecation and phantom gold, when this story falls apart, then that alone has to increase the gold price big time, let alone that coming at the same time that there's all this brand new demand. When people find out that there's a lot of fictitious gold out there, gold that doesn't exist, or gold that's owned by 2, 3, 4 parties at the same time, and they all think they have 100% title to it, when that starts to fall apart, recently the Commodities Exchange just added, I can't remember, it was like 100 and something, 127 new types of bars that are acceptable. And the reason they did that is because basically what they're saying is, well, any gold that's out there we'll now take because we can't get enough gold. That is the reason they're adding all of these other hallmarks to their bar lists of gold and silver. Both of these things are in very short supply. They can't get enough of it. And so they have to start accepting brands of bars that they used to not accept for some reason. They weren't good enough before. Suddenly, now they're good enough.
Now, I would like to take this opportunity to announce the Chris bars, which are now available. They don't look a lot like bars, but these are now acceptable as well. Chris bars, remember, pick them up with your Chris Bonds.
Right, very good. The Chris Colander there is what it looks like. Right, okay. Let's go on to the next topic, and that is the gold price itself. So it's been kind of flat. It's been down since it's had its big spike, which is not surprising that it's flat after such a big run, and silver too. But how long do you expect this, range trading to last? When do we see the next run in gold and silver? Is this something that's going to be days away, weeks away, months away? Not till next year? What do you think, Mike?
Well, I'm hoping that we do go through a consolidation phase and have a pullback, because I don't think there's a whole lot more time left to get ready, and there's still some things that I want to do before all hell breaks loose. And, if you look at the weekly transparent gold holdings and the weekly transparent silver holdings, what you see is that, when the price started taking off and rising, the amount of gold and silver that people were buying increased dramatically, and that drives the price even higher. But when it reached a certain level, the number of ounces being purchased declined significantly. And so a lot of the precious metals have been sold to the big boys at this price, and we've run out of buyers at this price. A consolidation phase will be something, where it just travels sideways or pulls back a bit. That would be good for gold and silver. And then you look at the commitment of traders reports. Now, I go over these with my insiders. I haven't gone over them that much with the general YouTube audience, but typically there's commercial traders, which in these charts are represented by blue, and then all of the speculative funds and the small traders over on the red side, and it all nets out to zero. For every long, there's a short. But the commercials almost always win, and when the price rises, they keep on adding to their short position. In other words, they're making up contracts and selling fictitious gold. They're promising to deliver someday in the future gold, but most contracts never get settled in physical. And then when the price falls, they tend to cover their positions. They buy these contracts back, and they make a profit on this almost always. They really got slaughtered in this last price rise. If you look at the chart, the price rise, especially on silver, they didn't cover their shorts when the price fell all the way down to $12 back in March. And so all of those shorts, as the price rose, they kept on losing and losing and losing, and they have never really covered. But they also didn't increase their position hugely on this last price rise. But they really need it to do a pullback so that they can cover these shorts and not lock in these huge losses that they've had. So with the reduction in the number of ounces that are being purchased by the big boys on the weekly transparent gold and silver holdings, and then the commitment of traders, it says to me that we hopefully, because like I said, I've got some books to finish. I've got some positions that I'm trying to take, and I still would like to accumulate just a little bit more. And I've been accumulating some silver exploration stocks recently. I want to make sure that I'm positioned right before all hell breaks loose, and it's going to break loose soon.
Right. I don't have much doubt about that at all, Mike. So, Chris, what do you think? Do you have a feel for how long the consolidation continues here for gold and silver?
Yeah, I got to confess, I don't spend as much time looking at the price movements as I used to, because I have this belief system that the prices are not really indicative of actual supply, actual demand, or actually anything except how the bullion banks would prefer to manipulate prices. They've been doing it for a long time. I've got a really, fairly deeply researched view about just how fictitious that market is, but not just those gold and silver markets. I could tell you a tale about corn. I could tell you a tale about lots of different stock issues as well. I really believe that this thing is a casino. And as a simple example, I don't even think the Treasury market, the U.S. Treasury market, one of the largest, most liquid markets in the world, is giving us appropriate price signals because the Federal Reserve has distorted and deformed that market to such an extent that you could ask me the same question, Chris, what do you think the 10-year is telling us about the future? And I'd say, I don't know anymore. It used to give good information. So I don't think the prices are giving us accurate information. So I'm spending more time trying to figure out who's doing the buying, why are they doing the buying, how are people positioning themselves? And you started earlier with the idea of a pension fund starting to move into gold. I see big money continuing to position itself in and around gold at the nation state level, at the family office level, at maybe now the pension level. So I think big money is still there and it's still interested. And that's what I care about most right now. And for all the same reasons that we've talked about, right? That the central banks are going crazy. They're printing like mad. They don't have an end game that they're at least publicly announcing. And they're just going to keep printing because they don't feel like there is no alternative, right? Tina, there is no alternative. So they print. And so what do? You don't play their game. And so I do see a lot of people positioning gold in gold. I can tell you from a personal standpoint, I've had more inquiries from friends and family who've known about my gold buggish tendencies, who've never talked to me about it, asked me about it in the last month. So there's that.
Yeah, very good point. I've had some friends and neighbors and things that are also asking me about gold that have never asked me about gold before. And so that's very interesting. I think on your point there, Chris, it's important to note that it's probably more important to look at how many ounces you own relative to your net worth as opposed to worrying about whether the price is going to fall $5 more and you might get a better value. So look at the number of ounces that you own. So, well, thank you guys. That'll do it for this video. Remember, both Mike and Chris have free books on their website. You can find them and download them for free. They're still valid and updated. So check those out there. So Mike and Chris, thanks for joining me again this week, and we'll see you at the next video.
Thank you, Jeff.
Thanks, Jeff. Thanks, Mike.